I'm Dan Duda, National Director of Production of Churchill Stateside Group. Who we have on with us from the Churchill Stateside Group as well is Alex Holverson, who is our Vice President and Midwest Production Officer, and also Michael Spain, who is our Southeast Vice President Production Officer as well. And also joining us today is our bond counsel, Norris, George, and Ostro. We have Wade Norris and Ostro and Kim Griffith on as well. So thank you guys for all joining. The contents of today, first off, we're going to give a quick overview of Churchill Stateside Group. We'll talk about some of the territories that the originators cover. We'll talk about just a brief overview of some of the product lines that Churchill offers, and then we'll dive into a deep dive on the private tax exempt loan execution, talk about structure, talk about terms, timing, and advantages of utilizing that program. And then at the end, we'll go into a case study on our recent deal that we closed in Tennessee. And then after that, we'll have the Norris, George, and Ostro team mention a few things on the structure and also talk about the bond market in general. So again, thank you all for joining. Churchill Stateside Group, so we are a financial services company headquartered in Clearwater, Florida. We have offices located in Atlanta, Chicago, Austin, and then we have a few other folks sprinkled throughout the country. We've done deals ranging from Washington State down through California, across up into the Northeast and Massachusetts, on down through Florida. So we do have a national footprint. We play in two major areas. We play in is renewable energy side of things, and then also multifamily. We provide both equity and debt to both of those sectors. But a big part of our business is really on the multifamily side. And on the multifamily side, about 85% of the deals that we do are in the affordable housing space, right? Either if it's a 9% tax credit deals, 4% tax credit deals, or even workforce housing or mixed income. So a lot of the products that we do offer really specialize around affordable housing and how to make those deals work. We have the ability to do pre-development loans, construction loans, and perm loans, and also through our HUD and USDA platforms, construction to perm loans. We have about $3 billion in assets under management. Our goal is to be a long-term partner and provide the best customer service throughout the term of the loan when we're doing the debt side of things. As you can see on your screen right here, this just breaks out the territories in more detail. If you are in a state showing yellow, that is my territory in the East Coast, the West Coast, and Southwest. The dark blue is the Midwest region where Alex Holverson is in charge of production, and then Michael Spain is in the Southeast part in the lighter blue. So we'll have our contact information for you all at one of the ending slides, and if not, we can also share this with you guys afterwards as well. So with that, I will pass it on over to Alex and Michael from the Churchill side to go into more detail. Thank you.
Alrighty, well, thanks, Dan, and thank you for that introduction. Thank you to all the attendees who are joining us this afternoon. We appreciate having you here. This is Alex Holverson. I'm the VP of the Midwest region, coming to you from Chicago, IL, and with me is Michael Spain.
Hey, good afternoon, everyone. Michael Spain. I'm based in Tampa, Florida, but cover the southeastern United States, and looking forward to being here today.
All right, thanks, Michael, and we're going to take it over from here. So one of the first things that we wanted to talk about before we get into the specifics of the new product, the Churchill Private Tax Exempt Loan, was just a refresher of some of the existing products and services that we provide. So the first thing that we have here is HUD. We are a HUD MAP and lien approved lender. MAP is the Multifamily Accelerated Processing Program, and healthcare is lien is HUD's healthcare programs. Both of these allow us to securitize and trade these mortgages on the secondary market. Churchill is a Ginnie Mae issuer and servicer, and that allows us to get the best rates in the industry for these loans. The majority of loans that we close here are the HUD 221-D4, which is for new construction and substantial rehab, and the 223F program for acquisition and refinance. Those allow us to offer 40-year amortization for the D4 and 35-year amortization for the 223F, and again, some of the best rates in the industry. Michael, do you have anything to add for our HUD business?
Yeah, sure. I think it's important to remind everyone that the 3-year stabilization rule for the HUD 223F, that's for refinancing your properties, that rule was eliminated earlier this year. I believe it was in February of 2020. So what that means is that, if your property is not even 3 years old, you can go ahead and refinance it. So if you have properties that were built, within the last 2 or 3 years, and they have somewhat of a higher interest rate, like for instance, if you have a project that was closed in 2017 or 18, and you got a rate lock at somewhere, mid fours or mid fives or even higher, we're going to be able to come in there and do a straight refi and substantially, if not cut that rate in half, and which will drastically increase your cash flow and make sure that the project operates a lot more sufficiently. And then again, also with the HUD 221D4 for sub rehabs and new construction, we're doing a lot of those these days, 4% and 9%. So, if you have a deal where you think that would be a good fit, just, get in touch with us and be able to show you what we can offer in terms of financing.
Yeah, thanks, Michael. Great points. And again, with that 223F and the historically low rates, as you pointed out, great time to refinance. And even with prepayment penalties, sometimes you come out on top because rates are so low, you get better debt service and better cash flow. So good time to look at doing that. The next program that we have is USDA's Rural Development 538 Guaranteed Loan Program. This program is specific to projects in rural areas, and if you do have a project in a rural area, this is pretty much the loan program that you want to utilize. So as you look through your QAPs, if you see a rural set aside, talk to us about the USDA 538 program. There's multiple options here for permanent or construction advance financing, and you are able to take advantage of 40-year amortization under this product as well. So it is a great program. Michael, anything else to add?
Yeah, if you have a project and you think that it qualifies for USDA eligibility, I highly suggest that you let us have a look at that, because there's a lot of great benefits to this program. And we are the biggest 538 program lender on the East Coast of the United States. So we have a very seasoned staff. We know all of the relevant people in the state and federal offices. We're currently doing these throughout a number of different states. And it's a great product. There's a 40-year term, 40-year amortization, very competitive interest rates, and it's a very smooth, efficient process. And just to touch on that a little bit more, if you have these projects that have existing 515 funds on them, we're also able to come in there with that 538 program, which can assume those 515 funds and then, reset it to a 30-year term, 50-year amortization, and an interest rate of only 1%. So if you have these portfolios, it's another option for us to come in there and look and help in terms of financing.
Yeah, thank you, Michael. Next up is one of our more traditional permanent loan programs, and that's our unfunded forward here as the CSG forward rate locked permanent loan. That's a very traditional unfunded forward, similar to Fannie Mae. However, this is a private loan program with some of our institutional investors, so there is no GSE involvement. This is underwritten, closed, and serviced by Churchill. Standard loan terms are 18-year term and 35-year amortization. And this is a great loan program to make your construction lender and your investor or syndicator comfortable at closing that you do have that permanent takeout in place. And moving on then, that moves us right into our construction financing, which we often team up with that unfunded forward program. But Churchill does offer conventional construction loans, again, underwritten, closed, and serviced by Churchill. And we also provide equity bridge loans or chubby construction loans. And a chubby construction loan, if you're not familiar with that term, is essentially combining a conventional construction loan with the equity bridge loan. So your construction loan is larger than what the permanent takeout is going to be. And that larger piece then is the equity bridge. And we call that, or refer to that as, a chubby loan. So very competitive terms, easy process. Again, we're seeking to be your one-stop debt shop, and we're able to do that through combining these construction loans with the permanent unfunded forward or equity bridge loans on top of either the 221D4 or 538 loan if you have an overhang of need there as well. The next product on here is bond underwriting, and that is asterisk. That is provided through our FINRA affiliate, Churchill Stateside Securities, and run by Guy Spieler, president of CSS. Guy is based out of Chicago in the office next to me. And through this bond underwriting program, we provide the bond underwriting for the public sale of tax-exempt municipal bonds to satisfy the 50% test in 4% LIHTC financed transactions. So this, again, is our purpose to provide one-stop shop financing for for the debt. We combine this with either a FHA 221D4, 220F, or the 538 loan, and are able to then provide public bond services for 4% finance projects. And I think that that leads us pretty well into the P-TEL itself. So to give you just an introduction of the P-TEL, again, P-TEL stands for Private Tax Exempt Loan. This is a proprietary product created by Churchill Stateside Group, and working closely with our bond counsel who is on with us today, Norris, George, and Ostro. And of course, that's Wade Norris, Ethan Ostro, and Kim Griffith, who are our attorneys who helped us structure this program. We built this program to compete with some of the GSEs who have similar but less competitive products, quite frankly. That's the Freddie TEL and Fannie Mae's MTEB. This program, again, is private, so it is originated, underwritten, closed, and serviced by Churchill through construction and into the permanent phase. And speaking of that, we've created this program to be both a construction and a permanent loan under one closing. So it is a construction advanced loan program. The program is for properties that have a tax-exempt private activity bond volume cap and are applying and going to receive the 4% low-income housing tax credit. P-TEL is a drawdown construction advance loan, meaning that there's no negative arbitrage. So while other programs out there, you fund and close all of your bonds at once, and then you're paying interest on those bonds even if they're unused. This program is different than that. We draw down the construction funds as needed, so you're only paying interest for the loan that's outstanding. Again, we close this under one initial loan closing. So when we close, we fund construction with the loan, and that's an interest-only construction phase that then converts over to a permanent phase at project stabilization, which typically lines up with every other syndicator stabilization requirement of 90 days at 90% occupancy, at which point the loan converts to full principal and interest amortization. Going back to the previous slide, we are able to offer a chubby construction loan as the construction phase on this product as well. If you do not have tax exempt bond cap for the equity bridge piece of this, that's okay. We can actually provide a taxable tail to the end of the construction phase as well. Typically, the construction phase itself is 24 months, again, interest only, and then the permanent phase is an 18-year term with 40-year amortization for most projects. For projects in less desirable areas or with a high expense ratio, we may have to revert back to 35-year amortization. But for the majority of the projects that we look at, we are able to get 40-year amortization for these loans. And the last bullet point on here is just to talk about the efficiency of this program. This is a very efficient program because of the way we've structured it with one loan closing, but also because we've worked with Norris, George, and Ostro to have one legal team from start to finish. So for your construction and permanent phases, we work with their group and save on costs there. And of course, those costs are then passed on to the client. So there's a reduction in legal fees and also just a reduction in time spent, on underwriting calls and on the large conference calls, getting all the teams together to get these things closed. And I think that's appreciated pretty much by everyone who works on these. So yeah, that'll lead us then into the structure of these tax exempt loans. And for right now, we're just going to focus on the 35,000 foot overview of this structure. Wade and his team are going to come in. They're going to dive into some more detail on how these deals are structured. And we know there have been some questions already from the group, so thank you for sending those in. And just as a aside to that, if anyone does have any questions, please feel free to type those in. We'll be addressing questions at the end of the presentation, and look forward to having some more person-to-person conversation towards the end of this presentation. But for now, just wanted to give you this overview. As you're looking at the slide, you're going to see that some of the names here are going to be different. Some of the terminology is a little bit different than what you might be used to with a typical bond structure. Your bond issuer under this structure becomes the governmental lender. Your bond trustee becomes the physical agent. And then from there, we have, Churchill Stateside Group is the funding lender, and then of course the borrower. But basically what's going on here is a tax exempt loan is being made from the funding lender, Churchill Stateside Group, to the governmental lender through the use of a physical agent, and then those proceeds are passed on to the borrower. And that's just what this diagram kind of illustrates. Michael, did you have anything to add here before we move on?
Yeah, sure. So just again, just to reiterate what Alex just said, and what's illustrated on the diagram right here in front of you is that under our Churchill P-TEL program, there are no bonds. The process is structured as a mortgage, and the bond issuer essentially becomes the lender, or what's referred to as the governmental lender here on the diagram. It's still tax exempt, and it qualifies under the bond issuance rule to get the 4% credits, but there are no actual bonds. It's very similar to a private placement of bonds, but we are structuring it as a loan. We would provide a construction to perm loan, just the one loan closing, and this loan product it's modeled after the Freddie TEL, but again with a private investor, so no GSE involvement, and there's a lot of benefits that come with that. Yeah, from there, we'll just pick up some of the program terms and conditions. As you see here, eligible properties, we're looking at 4% bond deals that are either substantial rehab or new construction, debt service coverage ratio of a 1.15 minimum, loan to value 90%, maximum loan to value. That is, this is a very high leverage loan. As Alex mentioned, the construction and permanent phase, the permanent phase being an 18-year term, 35 to 40-year amortization. That 40-year amortization is available. That's when the debt service of the deal remains over a 1.05 for the life of the loan. That I think that's a pretty easy standard to meet to get that 40-year amortization. So, there's a misconception that when you provide financing for 4% deals that, the sizes of these deals have to be huge. They have to be 180 units or something like that. But, as we're going to explain here in a second on our case study on one of these recent closings of the P-TEL that we've had, it was only 50 units, and it's because of that high leverage loan and then that 40-year amortization and a couple other factors that are able to help you make that happen. But as you see, you'll see these other requirements. Obviously we're going to try and give you this PowerPoint so that you can have this, and then obviously if you want to look more into the P-TEL program, all you have to do is provide us the development budget for your 4% deal, and we will input that data into our sizing model and show you what we can offer in terms of financing. Anything you want to add there, Alex?
No, I think you covered it pretty well. I think the terms kind of speak for themselves. And so I think we can talk about more on some of the advantages that come up using the P-TEL. So I'll turn it back to you, Michael.
Yeah, there's a lot of great advantages here, right? Private placement, no GSE involvement. This really speeds up the process when you don't have to be so dependent on a federal agency to, at the mercy of them making a decision on one thing or another. We handle it all in-house, proprietary product. Lower financing costs, no rating fees and others costs associated with the public offering. I think this is another, big win for the P-TEL program. This is a seamless process with one closing. Through the P-TEL, we provide a construction and permanent loan, meaning there's only one loan closing. The loan converts from interest only during the construction phase to interest amortizing payments at project stabilization. We have very competitive interest rates. The perm rate, is currently below 4%. The deal that, we were able to close last month that we're going to talk about here in just a second, we were able to rate lock that deal at a 3.91%. Low legal costs, we're happy to talk about that. We provide legal costs for both the construction and perm phases. And then again, speed. This is a very, very fast product. Again, we're going to be talking about, a case study here on the deal that we've recently closed. We were able to close that transaction in only 94 days. Which I think was, really impressive, and everybody was really pleased with. Well, if you want to, we'll hop right here into the case study, Burlington Commons project. This is a new construction project that's located up in Knoxville, Tennessee. I was just at the groundbreaking ceremony here just recently, but the project is a 50-unit new construction. Again, obviously a 4% bond deal with federal low-income housing tax credits. The project had a couple of different things going on. So the developer was able to obtain a city housing grant loan from the city. The mayor was there for the groundbreaking, and we were very happy to have them as a partner. The construction loan was $5.4 million, and then the permanent phase ended up being just under $5 million. So again, I think the total development cost on this project came in at just over $10 million. Again, not typically what you're used to seeing on these 4% bond deals. The total development cost on a typical 4% bond deal is 2 to 3 times higher than that. So again, just innovative financing solutions that we're able to provide and get these deals done. And I think it's something that we're very proud of. All of our partners that got together on this project, everybody was very pleased. And then, the developer that I worked with on this deal, we already have another one in the works that's moving forward, along with several others that we've signed up since then. So we're really, really happy really proud of this product that we're able to provide, and looking forward to working with some of you on your upcoming 4% deals. And that was really it for Burlington Commons. Happy to answer any questions anyone may have. And I'll turn it back over to you, Alex.
Yeah, well, Michael, I was just going to point out, I think you mentioned to me that the developer on that project's already looking to come back and do another one. Is that right?
Yeah. That's a good point. I'm glad you mentioned that. We're already underway on another one, another new construction 4% bond deal. And then, between Alex, Dan, and myself, we have several more in underwriting as well right now. So looking forward to what this program has in store.
Yeah, that's great. Thanks, Michael. I think from here, we're going to turn it over to NGNO, and I don't know, I think Wade's going to take it over, but here's all of our contact information. Of course, we're all going to be around for questions. Again, keep typing them in, adding them over for the end of this presentation. And of course, if you don't want to reach out to us now, that's all of our contact information. Give us a call later. With that, I'll turn it over to you, Wade.
Hey.
Okay, great. Thanks so much. It's a pleasure to be on the panel with you today and to chat about the P-TEL product that Churchill Stateside has developed. Why don't we start off, Kim, let you make a few observations. You have a tremendous amount of experience in tax-exempt loan programs and have been heavily involved in the first 2 deals that we've closed and helping us structure the program. Let's let you make a few comments, and then Ethan, turn it over to you for a little commentary on a couple of the other things that Churchill Stateside does, and then I'll fill in with some general bond market commentary and 1 or 2 comments at the end, and leave time, of course, for questions and answers from the audience. Kim?
Thanks, Wade. Ethan, since I've already talked a little bit, I'm going to kick this to you pretty quickly. One thing I did forget to talk about earlier when I was thinking about practical things that come up. Many of the deals that are financed through this program may well have tax abatement. And one of the things that we always want to be clear about is that we need to have confirmation that the tax abatement's in place. And often we'll need an opinion from a party at the table that the tax abatement's enforceable, and what conditions there are to maintaining that tax abatement, and assuring through the underwriting process that abatement will stay in place. Other than that, the sort of the practical things that I mentioned earlier, because we're remote, people need to build a little more time frame into it, and be on top of things as much as they possibly can. Ethan?
On my end, in the past couple of years, we've done several deals now with Churchill Stateside and Churchill Stateside Securities. It's FINRA accredited affiliate to underwrite publicly offered tax-exempt bonds to qualify for 4% tax credits. And in those deals, those were paired with FHA and rural development loans that were also underwritten by Churchill Stateside, and it allowed for a very seamless execution, because a big challenge on those deals, and even more so today, because of the challenges that Kim had noted, bringing the various sides of the transaction together, the debt components, the equity component, so that they all close simultaneously in a way that works together is a real challenge. And because Churchill now has a platform where they can do both the taxable and tax-exempt debt simultaneously, they've really been able to smooth the execution. And we've done several of these deals now all over the country, Pacific Northwest, on the East Coast and the Southeast, and we've got several more deals lined up, both actively underway and about to start going. So it's if the deal you have underwrites to FHA or RD, and you can get bond volume for 4% tax credits, that's another alternative that you have that Churchill can provide.
And one thing to add on the short-term cashback bonds that we use with the FHA and RD deals is this spring, when the COVID-19 pandemic hit, rates on short-term debt spiked to the ceiling, including rates on short-term cashback bonds, and we had a huge negative arbitrage problem on those deals. It could be 2 points or more that emerged very suddenly in March or April of this year. Well, those short rates are now back down. They're even lower than they were in February before the COVID-19 pandemic hit, so that those bonds coupons, which had soared up to 140, 150 basis points, are now back down to 30 or 35 basis points. And the negative arbitrage, which had risen with it on the deals, has now shrunk down to it's a half a point or less on those deals. So you pay the cost of issuance of the bonds, you put up 40 or 50 basis points of negative arbitrage, you set aside the 50% test, you get the very low rates that Alex and Michael were talking about that are available in FHA and RD loans today through the sale of Ginnie Mae's on a drawdown basis to the taxable market, and your deal is done. So very powerful product. And as Ethan pointed out, Churchill Stateside's equipped to do the FHA side, the RD side, they can do the tax credit side if you wish, and now they can do the bond offering, the security side of it as well. On the P-TEL product, I think from a big picture perspective, it's very interesting. If our view of it is what Churchill has done, they have for many, many years had a phenomenal underwriting platform that they've used in the RD space and the FHA space and tax credit transactions, etc. But they've now identified capital sources on the pre-conversion phase of these deals and the permanent phase of the deals that they can bring in, and having developed this sort of state-of-the-art tax-exempt loan program, it enables them to utilize the great skill set they have of underwriting real estate deals, processing the deals, doing it in a very timely manner to access these new sources of capital to bring them into these transactions as well. If you look at what's happened on the tax-exempt debt side of these transactions over the last 2 years, and frankly, we just did a deep dive into this because we've been trying to get a handle on what happened to rates during the pandemic this spring, how they came back down this summer, and we've just updated that to where are they today. Well, if you look at where long-term permanent interest rates are today, the 10-year Treasury was at a 3.25 2 years ago in October of 2018. The 10-year Treasury today is 70 basis points. That's an 80 basis points decline in the base permanent lending rate, the base rate that determines a lot of permanent lending rates on the debt side of these deals. If you look at 20-year LIBOR, it's down from 3.30 to 1%. It's a 70% decline in that perm rate. And so what has happened over the last 2 years is we've had a tremendous decline in long-term lending rates, which really has subsidized the ability to bring new capital into these deals and to make the deals feasible. We've lost some ground, and if you look at the impact over the last 2 years, if you've got, now some of that spreads have widened out a little bit since last fall, but notwithstanding the widening of spreads, that decline in the base rates, if the permanent lending rates on these types of executions are down from 5% 2 years ago on the average, let's say, to maybe 350, give or take, depends a lot on the deal today. That's a 30% decline in the long-term all-in borrowing rate. If you compare on a 40-year loan amortization, how big a loan you can support at 350 instead of 5 all-in borrowing rate, it's a 25% larger loan. So we basically gained 25 points in our ability to support loans through this sort of the tax-exempt loan program over the last 2 years based on that fundamental decline in long-term rates. Shifting from a 35 to a 40-year loan amortization puts another 5 points of proceeds on the table. So we basically gained on the tax-exempt debt side of these deals 30 points, which has enabled us to offset losses in tax credit equity 10 or 12 cents over the last year. That's a 3 to 5 point hit on total development costs. You know, we've lost some in terms of additional reserves that you have to build in to take care of COVID-19, et cetera. Obviously, construction costs have gone up. So there have been challenges, but they've been really more than offset by the fundamental decline in long-term rates and by the very creative accessing of capital to bring it in to the tax-exempt debt side of these deals. And the Churchill Stateside P-TEL program, we think, is a great example of that. So with that sort of overview, let me turn it back over to Alex and to Michael for Q&A.
Yeah, thanks, Wade, and thank you everyone for hanging in there while we were going through some of our technical issues. We are 100% finance and finance people and attorneys, and not IT people. So happy to be here to answer your questions on bond financing, but don't call us if your internet goes out. So anyway, it's 2020. What can I say? But yeah, so we did get some questions both before the webinar itself when people were registering, as well as some that have come in. Just to address a couple that came in recently, yes, we will be sharing this presentation once we've completed, and we'll also probably do some video editing just to get rid of some of those the silences and that sort of thing. So we'll share that all with you when we're done, so you can, if there was any part that you couldn't hear or didn't see, you'll have full access to that later on. Going over to one of the questions that came in with registration was a really good question just to start us off, and I think we can go back to that, is what's the difference between 4% and 9% LIHTC? And so for those of you that don't know, that obviously sort of sets this program apart from a lot of the other debt options that we provide. Right before we started, we were having a conversation between the 6 of us on that, and Wade, you had some pretty good thoughts and a really good overview. I thought it'd be helpful if you could share just what those differences are and what you're seeing there.
Sure. Glad to, Alex. Well, first of all, from a very big picture perspective, the United States produces about 350 to 400,000 apartment units per year. About 130,000 of those come out of 2 tax credit programs, 9% tax credits and 4% tax credits combined with tax-exempt bonds or tax-exempt loans. If you look at the 9% program, when Congress did all this back in the 86 Act, basically it is a very powerful subsidy. If you qualify for a 9% tax credit, you can syndicate those credits for about 70% of total development costs. You get a small 30% of total development cost loan from Churchill Stateside, closed loan, boom, you're done. Because it's such a powerful subsidy, it is greatly oversubscribed, generally 4 to 5 to 1 in most markets. And so your next best alternative, if you're doing an affordable housing project, is to use the less powerful but nonetheless very substantial 4% tax credit, syndicate that for 35% or 40% of total development costs, and get a larger loan through programs such as the one we're discussing here today, on a low rate loan on the tax exempt debt side of the deal. The 9% program produces about 60,000 units a year. 4% tax credits and tax exempt bonds are now grown to about 70 or 75,000 units a year. Both of them are very powerful programs, but again, you'll see in most markets a much greater availability of the 4% tax credits with the tax exempt bonds than you have on the oversubscribed 9% program.
Yeah, thanks, Wade. I think that's very helpful, and also helpful in understanding why more and more developers are seeking to utilize 4% credits over the 9%, and why we've decided to sort of come up with this program to help finance some of these projects. All right, going back to some of the other questions here, I saw a couple questions that were kind of project specific. If you do have any projects very specifically that you'd like to discuss, please give us a call. We don't want to get into anything too specific on this webinar with everyone on board, but very happy to talk about the various things that you're running into with your states, or with the local municipality or whoever that you're building your project with. So we're happy to discuss those in more detail with you. Reach out to Dan, Michael, or myself for those. If we need to get Wade and his team on board, we'll reach out to them and coordinate that with you as well. Going back to another question on here. What's the minimum P-TEL loan amount? So, you know, our minimums are not necessarily a stated minimum. It's more of what works for the deal. And what we see is that, you know, anytime that the permanent loan gets below $1.5 million, $1 million, things start to not really work out for the rest of the deal. It's not so much the loan itself that is driving that, but it is the economics of the deal itself that drives that. So I would say that you know, that's going to be more of a cutoff, but more or less, as Michael mentioned in his case study, you know, I think his Burlington Commons deal was about 50 units. Most of the people I've been talking to about these deals, they're concerned that their project isn't over 100 units, and we've definitely seen that it doesn't need to be that large to work. We can do some more, you know, some, I guess, smaller projects in the 4% space and get them to work under this P-TEL program. And then, of course, any large scale projects we can do under this program as well. However, just internally, again, due to the economics of how those work, we might start steering you to say, hey, that project itself may make more sense with a cash collateralized structure through CSS. And of course, we have, you know, Wade mentioned that those products, and Ethan mentioned those products as well. Some of those products work a lot for the very large bond products or bond projects out there.
You know, I should mention, Alex, if I might, one of the things we've tried very hard in designing the program to do is to make sure we've got a team that can really process even the smaller loans in a very effective manner. And we work with co-counsel on this. Austin Averett and Angie McEwen at Butler Snow are our real estate co-counsel. They're very experienced in this space and have done a superb job working with us to process, for example, Burlington Common in 94 days and get all the real estate deliverables in place that you need to do to close one of these complex loans. So having that sort of capability at hand helps a great deal in making a smooth, feasible closing, even for smaller deals.
Yeah, that's a great point, Wade. Thank you. And we do feel like we have obviously the best counsel to do these projects. As of course we've invited, you know, Wade and his team here, but also Butler Snow and their group, and having one team for both those construction and permanent pieces is extremely helpful in just navigating the documents themselves, but also reducing costs, which of course any reduction of costs we pass on to you, the client, the borrower. So that's a benefit to everyone there as well. And actually, I did get a question in here regarding loan documents. So Wade or Kim, could you go over just, you know, what is, by having one team, how does that impact our loan documents? Are we able to sort of reduce, or what's the efficiency that's received there by having one legal team for both construction and permanent?
Kim, you have been up to your eyeballs in the loan documents. Do you want to respond to that?
Sure. You know, I think that you know, the loan documents are pretty straightforward. You've got the sort of the typical tax exempt loan documents on one side, a borrower loan agreement and a funding loan agreement, which is a substitute for the, you know, trust indenture and loan agreement. But the construction side documents, the construction loan side, and the funding requirements then naturally flow into the permanent loan side, meaning that there are funding requirements in the documents that are signed at closing, not only for the construction period, but to convert the loan from the construction loan to the permanent loan. And those documents then that are signed up front then live on through the permanent period as well. So the efficiency is just that the documents kind of flow from the construction period through conversion and into the permanent loan period as a set of documents that we and Butler Snow have worked on together. We at NGO focus mainly on the securities and the tax side of the deal, but coordinate with Butler Snow as they're doing the real estate documents. And then there's some tweeners like mortgage is a really important real estate document, but it's really critical that it tie into the the way the funds are dispersed. And so we coordinate with Butler Snow on all those real estate related documents as they interface with the funding loan documents.
All right, thank you, Kim. We have about 10 minutes left for questions, so I'll go through a couple more here. The one question here, I think we mentioned a pilot or a tax abatement at the beginning of this webinar presentation, and we had the question of, is that required? No, it's not. A lot of the 4% deals that we work on have some sort of tax abatement, that they've worked with the city on to structure the deal, but it is not a requirement for the program. So that's easy one. Let's see what else we have here. Let me see. Dan or Michael? Yeah, Michael, go ahead.
I was just going to say, I see a bunch of people asking about availability of the PowerPoint and maybe specific questions to their specific deal that they're looking at. But just to let you know, we will be providing this PowerPoint. If you did miss it, if there were some technical difficulties, and we'll do what we can to make sure that you receive that. But even if you want to take it the next step, just feel free to reach out to us. We're happy to discuss any individual project, and that might be even a better opportunity for us to talk about this specific deal with you and see if it's something that we can partner with you on.
Yeah, thanks, Michael. Dan, did you have any? Did you see any questions come in that you wanted to address specifically on the webinar right now? We're reading from two different lists here. We had some stuff come in pre with the registration and then live here, so we're just trying to navigate those for you guys.
Sure, yeah, I'll just call out a few existing clients that I see making comments. Thank you, Art, James, Bobby. I think some of those questions when it comes to Art's question, the source of the P-TEL debt platform investors. Yes, we have an investor there on the construction side that will buy the bonds directly, and then we convert, and then we kind of trade it off to the perm long-term investor. But those are proprietary investors that we have for it. So to answer that question, Art, for you, James Presley, is there an income cap on residents for 4% deals, 40, 60%, 80% AMI? It just depends on the state and that allocating agency. Some states do allow mixed income or income averaging, which we're seeing more and more in different states. I know, James, you're in North Carolina. They do allow income averaging on bond deals. So that is good there. But some of these other questions too, it does look like they could be some deal specific, and it comes to cost and what have you. It just depends on the size of the deal, where that deal is located, in what state that is located. And so we can help navigate that, specifically if you reach out to us directly. So.
One thing might add, guys, that is a general item for those who are a bit newer to these sorts of 4% tax-exempt debt financings, is private activity bond volume has become an issue in a lot of states in the last year or two. In order to be eligible for the 4% tax credits, you have to finance at least 50% of the basis in the land and buildings with tax-exempt volume-limited private activity bonds. And there are now 8 or 10 states where volume is a significant issue. And these include your higher growth states: Washington State, California now, Colorado, Texas is getting very close to being constrained on volume, Georgia, for the first time in a number of years. And they've joined states like New York, New Jersey, Minnesota, and Tennessee, and other states where it was already constrained. So if you're planning one of these projects, reach out very early on. Reach out to your Churchill contact. They can get in touch with us. We can identify the availability of bond volume, how it's going to be scored in a particular state to help with that. Identify the issuer choices you might use in structuring your deals to put your team together, and do all of that on the very early end of the deal. Especially if you think your project is located in a state where volume has become an issue, an important thing to focus on the very front end of the deal. And we can help with that.
Yeah, that's a great point, Wade. I think we'll do maybe one more question and then just give it a second here to thank you all for joining us. So Got about 5 minutes left. I saw the question come in. What's the benefit to the HFA, to the housing finance authorities of this P-TEL program? And I think it's the fact that we can do some of the smaller projects, that you get a variety of what you're able to offer as far as number of units per project out to just out to the tenants themselves, out to the communities that you serve. So with the P-TEL, we're able to get some of those projects below 100, below 120 units that otherwise the economies just wouldn't work if you're doing the full public sale of bonds and you have all of the other parties that are involved with doing that and the costs that are associated with doing a public offering. Again, very much the larger projects work very great with HUD financing, with doing a cash collateralized short-term bond. They work very well under that program. But again, some of them that are less than, I would say about 120 units, less than that unit number is where this program really shines. And that's when where I think that the HFAs are in good hands coming to us to talk about those projects. Dan, do you have anything to add? You want to say anything here as we wind this down?
Just to wrap it up. Yeah, to wrap it up, we see all your questions coming in. We try to addressing as much of them as possible in a broad sense. We'll go through those questions that you all specifically have, and we'll reach out to you. I think we have your names and we have your contact information, so we'll go ahead and be proactive in that and follow up that way. But feel free to reach out to not only the Churchill folks, but Wade, Kim, and Ethan. And we appreciate you all getting on. For the folks that did call in via phone, I don't think you probably heard the pre-recording. I think you had to be on the go-to meeting. So we apologize for that, but we can definitely distribute those slides accordingly. And we see who called in and did not call in. So again, like Alex said, this is 2020. We apologize for any of the difficulties, but we thank you all for joining. Wade, Kim, Ethan, thanks for joining as well. We appreciate your partnership.
I feel like we're in that Progressive commercial.
Thanks, everyone.
There we go. Thank you all.
Thank you all.